Good evening, everyone, and a very warm welcome to this Chartered Banking Institute webinar event this evening. This has been hosted by the Scotland Members Network of the Chartered Banking Institute, which is recently rebranded from previously being known as the Edinburgh, Lothians and Fife District Centre. My name is Rory McIntyre. I work for NatWest Group and I also chair the Scotland Members Network. And I'm very delighted to say that we've got Marcus Wright of NatWest Group along this evening to talk to us. This is the second talk that Marcus has done for us. He previously did an economic review and outlook back in January of 2022, which was a great session. And we're delighted to have him back along this evening to continue that as we have an outlook, have a chat about the outlook of the rest of 2023. Marcus is a senior economist at NatWest Group, where he analyses economics dynamics to inform the bank's strategy. And he also heads up a forecasting and stress testing team, and there's over 18 years' experience as an economist, and has previously worked in an investment trust and also in an economic development consultancy. His particular areas of interest are the UK economy and energy transition and geopolitics, and he also has a first-class degree in economic science from the University of Aberdeen. So we're delighted to have Marcus along. Marcus, thanks so much for your time. So without further ado, I'll hand over to you, Marcus, and so you can get us started.
We're going to try and rattle through as much as possible. Of course, we'll touch on the economic outlook, growth and the labour market and inflation. Going to touch on a number of other things as well, energy transition and a bit of geopolitics as well. But yeah, very happy to take questions. A lot to talk about right now. A lot of areas we could dig into. I'm going to try and cover off as much as possible. So let's start at the top. The growth outlook, the better news that has seemingly been pretty steady over the course of 2023 with an improving economic outlook with each passing week, it seems. The genesis of which is the source of the problems of 2022, energy prices. So as much as they were the issue last year, they've been the source of the better news this year. The rapid and very significant fall in wholesale energy prices to characterise the past few months, so changing the outlook, changing the dynamics, changing confidence. Business surveys have seen a sharp tick upwards. The ever closely watched PMIs characterise that really, really well, with sharp move upwards over the course of February and sustaining that pretty much through March. I think a sectoral lens is important here because there are quite different things happening at a sectoral level. You can't talk about sort of one dynamic, whether that be sluggishness or really, really poor performance, and how that applied to everything. I think there's some really important distinctions here. So the way I think about it is, what I've done on this graph is compare the performance of sectors over the 3 months for which we have the latest data. So that's November, December, January. What was happening over those winter months in each of those sectors compared to the previous 3 months? Who's got momentum, who doesn't? And on the other axis is the performance of the sector really since COVID struck. So who have been the outperformers and where are the laggards? So in that top right quadrant, you've got those who are simultaneously had a decent 3 months and are actually, compared to pre-pandemic level, outputs higher or significantly higher. And certainly in the case of ICT, it's significantly higher. That is the sector I always draw attention to as being the real outperformer. What's that about? Well, it's about digitization, right? That is the structural trend in evidence that we hear much about. The latest manifestation of which is, of course, GPT-4 and GPT-4, ChatGPT, and the outputs of OpenAI. But look, the other interesting one here is hospitality, right? So despite the highest rate of inflation in 40 years, and despite the pessimism that prevailed around consumer spending, a squeeze on household disposable income that hasn't been seen in decades, hospitality has held up. And actually, when we take things a bit further forward, so look at that February, March, those business surveys, again, hospitality are the one that are saying, wait a minute, guys, things are a little bit better than what we thought. And that's seen quite a sharp uptick in sentiment. So the reading alongside that sector's moved upwards. ICT also, professional services also, business to business services, but even more generally. So there's a few sectors, not only had they said, well, things are maybe not so bad, but they're the ones, a lot of those that have said and reported in February and March that, yeah, orders are coming in a bit better and we're starting to feel a lot more optimistic about the outlook. And then there's idiosyncratic things going on elsewhere. So you might notice education sector performing quite poorly on a 3-month basis. So that's the impact of strikes, because the output in that sector is calculated by kids going to school. The one I want to draw attention to that's really, really important is health, right? So if we think about this, so we're talking about more than a 12% gap to the pre-pandemic level in the health sector, in which there are large waiting lists, as we know. That seems very odd. And this isn't the source of much of the problem within the oft-repeated stat that the UK is the G7 laggard. Output in the UK is yet to, across the piece is yet to regain its pre-pandemic level. And actually, because the health sector is 10% of the economy, you know, if you're talking in excess of, well, it must be at the sort of 14% mark there, output down on where it was pre-pandemic. That's much of the problem, right? So that is certainly an issue, and as best as I can tell, looking at other countries, don't have that same issue. Output in that sector is well above where it was pre-pandemic in the US, for example. Manufacturing, it is a much more cyclical part of the economy. It will go through periods when it's performing that bit weaker. Again, maybe some cause for optimism, new orders picking up. Participants within that sector starting to feel a little more confident about the outlook. Real estate inevitably a victim of high interest rates, and so that explains what's going on there. But look, so this is a very different performance across sectors. But I say the good news is for the economy collectively, better news. And although this year will be a struggle, it's not going to be characterised by a recession. It certainly does not seem that way now. There's just almost a bit too much momentum. No doubt the economy has been buffeted by high inflation and high interest rates, and the effects of which are yet to fully play out, particularly on the interest rate side. There will be a lot of folks rolling off mortgages onto higher payments over the course of this year and into next. But the resilience, and that's a word we've used quite a lot in recent months to talk about the UK economy, is very apparent. And that is in some of these sectors, it's in household balance sheets, it's in much of the business landscape in terms of their own financial health. And that's been really, really important. And economists have pointed to that for a number of, many a quarter now, for the reasons to expect any downturn to be modest, because there is resilience and because some of those key parts of the economy, health of the banking sector, health of balance sheets, debt levels lower than what they were going into the financial crisis. So a lot of those critical vulnerabilities that would have been quickly turned to, certainly around the time of the financial crisis, in pinpointing weaknesses and vulnerabilities, they aren't there to the certainly not to the same extent, and there are strength in critical areas that give the economy that bit of protection. Now, it doesn't give us the strong momentum, and it doesn't certainly at the current juncture look like there's about to be a sudden lurch into super fast growth. That's where the structural element comes into play, and I'll talk about that slightly later on. So that's the sector side. Skipping ahead too far. On the labour market, again, the word resilient can be applied here. Job growth just held up. Now, the forecast remains that you'll see the unemployment rate inch up a little, or whether it's the Bank of England's forecast or the OBR's latest forecast or the consensus generally, you'll see an unemployment rate forecast that is inching up from the current 3.7%. That's primarily about people joining the labour force and it taking a little bit longer to find a job, rather than outright headcount reduction. It's a nuanced picture here. Yes, there's a little bit of that. Indications of redundancy have picked up, but they remain historically low. There just isn't the widespread need or signalling from firms that they're about to reduce headcount significantly. That's just not coming through in the surveys. And because there's greater confidence around the outlook, order books a little bit fatter than what had been anticipated, that makes that outcome of large levels of jobless and headcount reduction less likely. And obviously that's critical, as there isn't really a a variable, the health of the labour market, that plays a more important function in thinking about the outlook for credit for a bank. But there's interesting things happening underneath. There are challenges, and it's changed a lot, the UK labour market. The trump card of the UK's economic performance post-financial crisis, one of these success stories, how we raised the unemployment rate, the number of people we put into work. The past few years in COVID has put a lot of that into reverse. There's been a big rise in long-term sickness. So this is the nexus of the problems in the healthcare sector and the labour market and economy more generally. That's where on the Venn diagram things overlap. Yes, early retirements played a role, but long-term sickness here is the big issue. And you can see here, I really like this chart on the left, the role that immigration has played in bolstering, continuing to play a role in bolstering labour supply, and a really important one. And that looks like to be the case going forward. And it needs to be, because that's the requirement is simply there. There is a requirement for both UK and non-UK workers to join in greater number. And hence the chart on the right, the efforts to, what economists say, cajole the supply side from the Chancellor to raise participation through a number of support mechanisms, changing of incentives. And the OBR, as is its role, as is its duty, sets out its estimates of the impact that'll have on the labour supply side. And it is some. It's not enormous, certainly not, but it is some. It'll take a while to filter through. But if there is another lesson to be learned from previous reforms, so thinking back to the Conservative Lib Dem coalition government, economists did underestimate the effect that reforms on the supply side, encouragement to work, would have. And frequently in the years immediately following 2010, were caught a little bit on the hop, so to speak, as the speed at which the labour market recovered and the numbers joined the labour force. So that could be the case again, that actually these have a stronger incentive to bring people into labour force. But only time will tell. In the meantime, as I say, good news, job growth has been better than what we anticipated. Redundancies low, have come up a little bit. Employment surveys indicate that, yes, that job demand growth is cooling. It's not crashing. So that would be, that's consistent with the broader cooling in the economy that's happened over the past 6 to 12 months. But it's not signalling anything particularly worrying. And so some of those labour shortages that were top of mind, rewinding the clock a year, they're not as acute and actually look pretty typical. Labour shortages are commonplace in any sort of period in a number of critical roles. So, but they've kind of reverted to type, so to speak. They look pretty normal. So indications of in economist parlance, a loosening of the labour market gradually. And that is expected to continue to be the case over the course of this year. And so don't be surprised to see unemployment inch up a little bit. Similarly, as I say, the labour market has outperformed time and again. It's confounded expectations. Don't be surprised if actually the rise in unemployment is very modest, and that it remains, pretty solid, all things considered. So this is the best chart that sort of sets out this issue around the energy crisis and its aftermath of last year. The good luck that warm weather played, we all know that. And last year, good luck supported by a China that was still pursuing zero COVID. And so it was easier, albeit expensive, to draw in the necessary gas, build storage levels to see them through a winter that, as I say, ended up being mild. They've come out of the winter with storage levels looking pretty good. That chart probably needs updated, but there's the position that Europe is in ahead of the next winter looks increasingly good as well. At the moment, it's difficult to see a rerun of what we experienced, particularly in late summer last year, and truly eye-watering levels of energy prices. But you can't rule it out. There are a number of dynamics at play. You have a recovering China. Inevitably, demand around various forms of energy will increase. It's not happened yet with real gusto, but that's expected to change as the year progresses. And we're seeing a little bit of the the risk around commodity prices more generally, just in the past couple of days, OPEC's decision to cut output levels and feed through into oil prices and the usual revision upwards of those who do such a thing to oil prices at the end of the year, with some of those bearing down on the $100 level. There is a vulnerability here because there are tight markets across the piece inside the commodity space. So whether you're thinking about the metals key to the climate transition, we have a kind of mid-term copper deficit, right? And there are various other supply concerns around all the other critical materials, whether it be nickel, cobalt, lithium, over the years into the remainder of this decade. But it's about oil, and it's about gas, and it's about their products. Keep in mind that in helping to keep oil prices contained last year, it took a significant reduction in the US Strategic Petroleum Reserve back to the levels last seen when it was being built up. The Strategic Petroleum Reserve was a response to the oil crisis in the 1970s, and it was built up, added to during the 1980s, and we're back at levels last seen in the 1980s. So it's taken a supply response, including a dramatic drop in Strategic Petroleum Reserve, to sort of keep oil prices contained. So there's just tight markets and there's vulnerability there. Just keep in mind that conventional oil production has actually peaked, and it peaked many, many years ago. The only reason we have globally more oil output compared to where we were. So yeah, so it teased out the outlook for energy prices, and critical. The point here is, look, at a headline level, inflation is going to fall. It's going to fall sharply over the course of this year. There is residual heating core prices, and that is squarely on the Bank of England's radar. You hear them talk about that a lot. Markets think there's one more hike to come. That economists think that the Bank of England's done. We await the clear-cut evidence that core price pressures have abated. The signals are that they will do, because further up the pipeline of inflation, we can see cooling happening, and there are hints that wage growth too is peaking also, and that makes sense given our interpretation of what's happening in the labour market, that it is cooling and that some slack is developing. So we should get the alleviation of those pressures. But I think what the last data point told us is this won't be a straight story. There was an upside surprise in the last inflation reading, caught the Bank of England a little bit unawares, and certainly contributed to the decision to hike. And I think we should be prepared for similar. Inflation is just, it's so high, and there is, it's bled into so many areas of the economy, so many price setting behaviours, that we shouldn't be surprised to see that it be a bumpy ride. But that headline level should see some significant falls over the course of this year. It remains an open debate whether that is, that will be it, and we will revert to the world that existed pre-COVID. I'm not sold. I think we might have done enough to break what existed pre-COVID. There are a number of reasons to think that we'll see a structurally higher rate of inflation, and perhaps rates. And it comes back to demographics, and it comes back to deglobalization. And I think those will be critical factors that make for a much more bumpy, volatile, at least, and possibly structurally higher rate of inflation. Now, on the other side of the current 10% level rests, in all likelihood, a very low level of inflation, because it's been so high. So base effects kick in. The OBR certainly thinks so. So it foresees very low sub 2% rate of inflation, something close to zero, in fact, from around the middle of next year. We can certainly hope that'll be the case, because earnings, even if they come right down, will be firmly in positive territory in real terms. And that way we start to undo some of the damage, we do the repair work to incomes from the past 2 years. Remember that inflation has outpaced wages since the back end of 2021. So that's quite a bit of damage. That is the cost of living crisis. So there's a bit of repair work, as I say, to be done. But there's risks around that, whether it be through the structural element around demographics. It's the energy space as well. So yet to be confirmed that we've defeated it properly. And one final lesson, the 1970s taught us that could very well be the case. Inflation rallied significantly following the first oil price crisis, 73, 74. It then fell back in the mid-1970s and fell back a lot, only for it to rally again as another energy crisis unfolded, and we hadn't tamed the pressures, the underlying pressures, and it took, in the case of the US, Paul Volcker and some harsh interest rate medicine to properly tame those inflationary pressures once and for all. Right, on the deposit side, this is getting a lot of discussion inside banks. So the very unusual circumstances, and this chart spells it out nicely. So what this does is take how the deposits held at banks by private non-financial corporates change in Q4 over the past 20 years. And we see quite a significant decline. The question has been, where's it gone? There is, unusually, certainly in the context of the past 15 years, a clear incentive to move deposits into other areas. Is that gilts? It doesn't look that that's the case. PNFCs hold a very, very small amount of gilts directly. There has been a move, or certainly there was in Q4 of last year, a move into debt securities, specifically short-term debt held by UK monetary financial institutions and money market instruments in the rest of the world, which is more than likely to be the US. So it's a difficult story to get to the bottom of, but there's, as I say, there's certainly clearly an incentive for funds to move out of bank deposits, and it looks like there's been a little bit of that happening. But there's been pay down of debt. That's come through in the figures as well. And then there's just the macro pressures, So we've got private sector wage growth at 7%. We've got the residual of high inflation in a lot of key areas. So there's macro factors at play, but it does look like the incentives around rates are playing a role as well. On the household side, on the next slide, the key question has been, are households going to jump into using their COVID savings? Rory, you could move us on to the next slide, could you? Are households going to jump into their COVID savings, which are significant at about £180 billion? You're talking about 8% of GDP. What does the data tell us? Ever so slightly is maybe the best way of putting it. So I'll circle those three bars at the end. And what households have done, or some of them, for those who are able to, they've been saving a little bit less. So supporting their spending through not squirreling away quite as much. But it's relatively modest, right? So the red line is the average. You're talking about 5 billion that would customarily make their way in any given month into bank accounts. And it's been slightly less than that over the past 3 months. Yes. Do expect this to continue? It would be reasonable to think so. Inflation and its effect on household finances can have quite a lag. You sort of struggle to make those adjustments to your standard of living. So it wouldn't be surprising. And there's only the OBR's forecast is for the savings ratio, so how much in a given month a household will squirrel away, to be relatively low over the course of this year. And that's because many are able to. Well, about a third of households have little to no savings. The rest, to varying degrees, do. And naturally, some have, as this chart shows, very, very significant amounts. And hence that many, as we all know, have been, again, very unusual in the context of the past 10, 15 years, moving into time deposits. So there's been a big inflow into locking them away for some better returns. Right, on the next slide, Rory's got a very reliable connection here. Something I find interesting. So what have households done in response to the cost of living squeeze? Well, they've cut back on some non-essentials. We can see that. They've also, and this is where you can really see price signals working quite well, they're using less fuel in their homes. So turn down the thermostat, sticking on a jumper. And this was widely reported to be the case across much of Europe as well. And the statistic that was doing the rounds was since the 1990s, the average temperature across households had risen from 19 to 22. And if we were all prepared to go back to the 19, there wouldn't be an issue around gas. So it does seem that many have turned their thermostats down and not prepared to go back to the average temperature that existed in the 1970s, which was 16. I think we can all agree that we draw a line there. But spending less on the non-essentials, turning down thermostats, using less fuel, have been where they have made some changes. Right, on the next slide, should have a bit of a zoom out. So we talked a lot about the slightly better cyclical news, and that we've all heard plenty about, and forecasts being revised upwards. Still challenging, still effective stagnation when we're talking about in GDP terms. But into play here is conversations around the structural element and what has held the UK economy back for a number of years. And I like to tell a story with the help of a chart like this. So we can see in the period running up to the financial crisis, roughly speaking, where we made gains. So the benefit of reforms undertaken in the 1980s and in the 1990s really played a critical factor in what was outperformance and a bit of catch-up. And that had come after a period of falling behind. So this really does move in cycles. So while the gains in our standard of living over the course of the 1960s and the 1970s were rapid, it's just they were significantly more rapid in other European countries. And by the time the 1970s rolled around, which was the decade where many families were taking their first holiday, it's a decade that gets a bad rep, and actually it saw significant increases in the standard of living. So many families taking their first holiday would have found, as they looked around the bag carousel, that their European peers for the first time, that, wow, they look considerably richer than what we are. And the UK had fallen behind, and as I say, the benefit reforms led to a period of outperformance and catch-up up until around the time of the financial crisis. Since then, it's another period of underperformance, and the gap to what we'd all achieve to, we would all like to be, the standard of living similar to our German and US peers, not just those, but others as well, whether it be Dutch, Swedes, Danes, Finns, Norwegians, the list is long. That gap has grown again, and that is the failure of productivity. That's the failure of reforms to tackle the slow underlying pace of growth that the UK has exhibited for some time. Now, this is slowly coming to the fore, and I say within the budget were some efforts to try and do something about this, but the reforms that we need, we're not having the discussions about as a country, and they remain in short supply, because this is about many years of underinvestment in infrastructure and critical parts of the education sector underperforming, and investment in R&D, and how much we are able to use those things that really push the technological frontier, how quickly they disseminate down the business base. There's a whole host of quite difficult problems that will take many years to sort out, and that if we were to do something about them now, many of the fruits of which probably wouldn't come to the fore until later this decade or into the 2030s. But the challenge is very, very real, and the culmination of many years of underperformance in intangible investment, broader infrastructure investment, education, R&D, dissemination across the business base of management best practices, best technologies, new technologies, yeah, that's the story. Other countries do that little bit better, and so this is right now. This is going to put a brake on growth. So we can and will see a recovery in all likelihood over the course of H2 and into 24. But the UK has a bit of a brake on its pace of growth. It is capable of growing, absolutely, but really pushing into the 2% plus 3% pace of growth, it will more than likely remain elusive while efforts around these reforms remain in short supply. Right, moving on to the next slide. Very quickly touch on the US, because it's critical. The past week's events around banking sector volatility, the expectation is, if it's sustained, it's likely to have. So go one slide up, Rory. it's more likely to have a more of an impact for the US economy and lead to tightening credit conditions by dint of the fact that small and regional banks just play a bigger role in the economy. They contribute to the majority of financing of commercial real estate, for example. And so what was already an elevated likelihood, economists' estimated likelihood of a recession in the US has kind of ticked back up to where it was, 65%. And it was already a challenging outlook if we look at the quarterly growth profiles that economists had set out for the US. Just like us, that's the lagged effect of higher rates and just weakening in the cycle. But that's probably the key difference, is because small and regional banks play a bigger role in the economy with allocating credit, a tightening in credit conditions has a bigger impact on the US and sort of broad economic activity. And that is effectively the story there, and why it's expected to be more material from a macro sense. And on the next slide is set out that, so if small regional banks play a bigger role in commercial real estate, what do we know already? Well, there's signs of weakening because prices already started to fall, that's higher rates, and you're seeing transaction volumes decline. You're seeing vacancy levels pick up, particularly in the office space. So there's some vulnerabilities there. Rents are holding up fine. This is not some sort of it doesn't look to be something cataclysmic as of right now, but there are pre-existing weaknesses in US commercial real estate, which are tightening credit from important players of allocating finance that will serve to compound. Right, moving on to the next slide, we'll touch a little bit on maybe an angle to geopolitics, and that's deglobalization. And so the way I think about this is, yes, geopolitics plays a role in the outlook in a way it hasn't done for decades. One of the manifestations of which is this deglobalizing trend, which is in some form underway and has been for some time, but it's not uniform. Again, that word nuanced. So I think that in critical areas, so if you think about AI and computing, quantum computing, space, those critical sectors, there is likely to be an increasing deglobalizing trend. That wouldn't be a surprise, and there are many bits of legislation you can point to that are already pushing in that direction. Multiple bills passed by the Biden administration is over the past few years being a good example of that. And it's as I say, many of these headlines, although some are new, some are a number of years old, where it's the resource nationalism point and a desire to move manufacturing back from areas of lower cost. The trade war, Trump's trade wars, is now 5 years old, and we actually have quite a bit of data, and we can point to noticeable changes. We can see reshoring happening, or sources of areas of production changing. In the areas where tariffs have been highest, we can see a decline in US imports from China and a rise from other areas, whether that be other parts of East Asia, Southeast Asia, or with areas closer to home. I'm thinking particularly of Mexico. So we can see these effects. Tariffs do work, and they have led to changes in the global manufacturing setup. And much of what we're seeing right now is just a continuation of this. And I think that's one of the key elements about geopolitics playing this more prominent role. It's about deglobalization. And actually on the next slide, it's what we can see is a look at, so one critical element of the green transition. Now, one of the aforementioned many important big spending bills passed by the Biden administration is the Inflation Reduction Act. And it has been critical, really, in changing the landscape around the energy transition. So we think about the EU, which has been, a pioneer in this, a real trailblazer in a lot of cases for a number of years. Its efforts were concentrated around putting the emphasis upon the private sector. So that was the expectation, that the private sector would bear the burden of the costs of the energy transition. And what this chart on the left shows is the anticipated revenues from their carbon tax. What's happened to date, what's expected to happen over the course of the remainder of this decade. And these are significant sums. You're up at 700, 800 billion euros by the end of the decade. But the key point is that it's the emphasis and the burden is borne by the private sector. The US is entirely different, right? And the Inflation Reduction Act is the state taxpayers ultimately assuming the responsibility, and the fact that the spending through the Inflation Reduction Act is set to come mostly through the IRS and the Treasury. So it's tax credits. Highlights that issue quite neatly, and these are material changes. So you've got an expectation that hydrogen costs will go negative, and actually many of these tax credits are uncapped. So although the hundreds of billions of dollars estimate of the Cost of Inflation Reduction Act are the figures that have been doing the rounds, there are many that estimate that it's far higher, the order of magnitude hundreds of billions higher, once you factor in things like, well, how many carbon capture and utilisation storage projects are actually ready to roll, compared to what the Congressional Budget Office, which sort of sets this stuff out, assumed. And the figures are very different. So you could be looking at hundreds and hundreds of billions of dollars spent through this means. But it's fundamentally different, and that's critical. And actually, it's closer to China, whose emphasis has been on utilising state support, and that has enabled them to build up successful green tech technologies and really come to dominate those sectors with 70 to 8% market share in whether it's wind turbine manufacturing, solar panels, battery manufacturing, metal processing, all the key elements around the energy transition. China has very dominant market shares, and it's the result of decisions made not a few months ago or a couple of years, but 5, 10, 15, 20 years ago. And the US, the Inflation Reduction Act, is a belated response to that, but it's closer to China's approach, and it's left the EU in a difficult position. The UK cannot match, naturally, the pure funding power of whether it be the EU, the US, or China. So it'll be more difficult, but it does pose a lot of interesting questions. Do you try and do similar? Do you let the state assume responsibility and funnel money, cash transfers, tax credits into some areas and tie up with other countries in the other critical areas? But these are some of the key decisions that await, because the opportunities are enormous in this area. It will be a key driver of growth. We are already seeing it. We're seeing strong economic incentives for the energy transition in the power sector and in ground transportation, well in train and set to continue. Other sectors are lagging, of course, industry and property, but that may well change given the right regulatory incentive and setup. I think very finally, I have a chart on that sort of just illustrates that point, these dominant market positions that China holds. And this is really the confluence of geopolitics, deglobalization, and the energy transition. So the big trends shaping the world right now and in the years to come. In the middle sits our alliance for all the things that we must have, and we really must have for the energy transition, sits China having a dominant role. And that poses a lot of interesting questions, whether that reliance is sustained or the efforts become really concerted to increase your resilience to geopolitical fallout and have more of this stuff happening at home. We know it's critical. We know demand is going to go through the roof. In a lot of cases, it already is. But there's a vulnerability there, and the world as it's currently evolving means that's very likely to remain the case. Right, I think I've talked long enough. The IT just about held together with the help of Rory. I think we'll stop and take some questions.
Perfect, thanks, Marcus. Yeah, thoroughly enjoyed that. I'll stop sharing my screen then, and we can have a bit of a chat regarding the Q&A. So, for those of you in attendance, feel free to pop any questions you have into the Q&A box regarding any of the content that Marcus has went over there. Marcus, if I could start us off with a question, if that's all right, while our audience have a think about any questions they would like to ask. this is obviously the second session that you've done with us. And I remember I received a great question when you spoke with us last January, and actually you've covered a good bit of the content there, so it's probably quite a generic and high level question, but I just thought I'd revisit it because I remember at the time being really intrigued about what your answer was. And one of our attendees last time they'd asked you the question to discuss how much you thought that the effects of both COVID and the UK leaving the EU had kind of greyed each other out. And I think at the time you'd said that, well, actually, we weren't actually at the point in time where we could really truly realise that. Now, kind of 14, 15 months on, I imagine it might be still a bit of a similar answer, but in the light of us now moving out of the pandemic, what's your kind of high level thoughts on that question?
Yeah, I remember that. And it is a really good question. It's an important question. And we do know a bit more is the answer. You know, we can see the performance of our trading sector, exports remain a laggard relative to our G7 peers, and that's like our evolving trading relationship with our biggest trading partner is likely to play a role there, and that's a fairly widely held view. Now, we know of late that some of the opportunities are beginning to appear, which is encouraging. But as of right now, our export sector has underperformed. And into that, we can also put business investment. Now, business investment is a tricky one because there's likely a number of factors at play. So, changes in the tax environment, uncertainty around beyond the very short term as to what the environment is, all the type of things that put businesses off investing. So it's certainly not just about our trading relationship with Europe. But business investment is another area where the UK is an identifiable underperformer and has been for a number of years. So while last year we might have thought, well, let's wait for a few more quarters of data post-COVID to see how it's doing. But it's, as I say, that story is just that bit more clear cut. The underperformance of the UK in business investment is very clear. And again, this sort of trading relationship is very likely to play a role. It is certainly not playing the role, it is playing a role. So there's two critical areas. Business investment, just 10% of the economy, and our export sector.
Brilliant, thanks. Really interesting. It'll be good to see how that plays out in the months ahead. Still no questions came in from our attendees, so folks, feel free to ask the questions. We have had one from Sujata just asking about if we could get the slides. I don't know if we'll be able to do that to all attendees, but the recording will be on the Chartered Banker YouTube page within a couple of days, Sujata, so you'll be able to watch back if you've got any questions there. Another question I'll maybe just ask you from myself, Marcus, if that's all right. I'm taking up all the time here while we wait for our audience to ask. Is you obviously spoken a lot about geopolitics there and also what is kind of changing currently regarding the deglobalization. In terms of, I know that you've mentioned in the past call with us about how kind of consistency and certainty in the political landscape does support, obviously, our kind of strong recovery from the situation we're in just now. We obviously had a bit of a tumultuous time a couple of months ago when we had Liz Truss as the Prime Minister of the UK for a brief period of time, and the kind of fluctuations that we've seen at that point in time. Under the leadership of Rishi Sunak, it seems that we have a little bit more certainty and consistency going further forwards. From your perspective, how have you seen that progressing now beyond that, and how did you see it at the time?
Yeah, so again, it's a really good question because it became difficult during the autumn to disentangle what was a slowing trend because of high inflation and something being experienced across all countries, disentangling the slowing trend from the compounding effect of what was a hit to confidence from the events surrounding late September. And a lot of the business stories in the data told that story because there was a mini slowdown that happened in the aftermath of the mini budget, which then we got a bit of recovery from, but we also had better data, lower energy prices, a general sense that actually things are not going to be as challenging this year. So disentangling those two things became quite difficult, but it clearly played a role. And I think that, the relative stability following that has helped with what has been an upturn. Is it the driver of the better news and the upturn? No, it's not, because again, it's an experience shared. There is remarkable similarity between the trends in what's happening to business surveys in the UK and Europe, right? And that's where our fortunes are often tied quite closely in that respect. So that I think that gives us. Look, we're now moving into. We're not too far away from thinking about an election year, right? And so attention will turn to, if the polls are currently to be believed, how does economic policy different? How might it evolve from where we're currently at? Again, the energy transition is probably one key critical area to think about. We might get more sort of concerted action around that. We might not. The constraints around the public finances may really limit any sort of deviation, big deviation in policy and approach. But we're starting to get into that kind of territory. There needs to be an election held by, I think it's January 25 the latest. So we can look at the very back end of next year. That's kind of where we're at.
Interesting, thanks for that. Yeah, and you're right. A lot of it is intertwined, so it's quite interesting to see what we're seeing here and what we think is maybe the cause. But actually, if you're seeing the same trends happening elsewhere, it's quite interesting to know it's maybe not having as much of an effect as we think. Still no other questions coming through from our attendees who are still here listening along. So I'll maybe ask another just kind of small question from myself, Marcus. Apologies for just taking up all your time with questions from me. You mentioned something really interesting regarding the trends we're seeing regarding deglobalization. It's a subject I'm not really that familiar with, but I thought it was quite interesting what you were talking about large economies like the US doing a lot more in-house or maybe going a little bit closer to home. Do you see there being obviously those countries that are maybe closer to home, such as Mexico, without having the same economic strength as the US, will there be an obvious benefit to countries like that who are now becoming more reliant, or do we still see that overall from a global perspective, because of how much China is a superpower, that will still have a negative effect across the wider piece?
Yeah, so big question. So Mexico plays a really important kind of complementary role to the US manufacturing base, and it's inevitably as you move further south through the US, the closer the ties. So it's strongly tied into the success of Texas. Now, Texas effectively, or the sort of triangle around its big cities, has basically been about the best performing economic area in the West over the past decade. So my battery's running low. And Mexico plays this complementary role through relatively cheaper manufacturing. So not as, let's say, not as competitive as what China is across the piece, but once you factor in its benefits of being closer to home, there is a compelling case suddenly emerges. So the thing about the US is if you were thinking about a deglobalizing world and you were thinking about, right, well, you're going to need food security and you're going to need energy security and you want to have a strong manufacturing base, a competitive economy with strong links into other countries who have the things you don't. You run down that list and there's a lot of ticks that appear alongside the US. It is an agricultural powerhouse. It has achieved energy independence over the past decade because it discovered a Saudi Arabia equivalent in oil and in gas. It has huge potential around green energy production. I think it's got positions 1 and 2 in terms of wind and solar. I can't remember which round it is, but globally, wind and solar has positions 1 and 2. And I say that kind of strong integrated manufacturing base with the world's best universities, and ability to commercialize that research. So you've got this real compelling case. And the energy independence one was a game changer, right? We underestimate, it never got the focus it deserved, just how important the shale revolution was to shifting the outlook and really changing the course of history, because it just made the US able to operate in a completely different way and reverse what had been 40 years of declining oil production. Oil production in the US peaked in 1970. It went on a downward trend through to 2010 and then rose significantly over the course of the last decade. So it has a strong position in a deglobalizing world, and it's demonstrated it's quite prepared to use those to achieve its own ends and influence around the world. Ultimately, Europe would not have been able to do what it did in response to Russia without US shale, right? Mm-hmm. And so it's played a critical role there, and why it's and some of the actions we've seen around China as well. So yeah, I mean that's the story there.
Brilliant, thanks, Marcus. That's really interesting, and that's brought us bang on up to time. So yeah. So once again, Marcus, thank you so much for your time this evening. We really appreciate you coming along and sharing all your wisdom and knowledge on this. It's been great having you along for this session and the last one, because I've certainly got an awful lot out of it. I hope our audience that are along with us this evening have got the same, and anyone who's also now watching this back on catch up. For those of you who are in the audience or watching it back in catch up, please keep an eye out on LinkedIn for our recently rebranded Scotland Members Network of the Chartered Banking Institute. We'll be hosting a couple of other events coming up, including a rebrand launch night in person in Edinburgh at the Library of Mistakes in early May. The details of that will be shared shortly. But yeah, once again, I'll bring us to a close this evening. So Marcus, thanks again from all of us for your time. Heather, thanks for supporting us with the technology, and to everyone who's here this evening. Hope you enjoy the rest of the evening. Thanks a lot for joining us.